What is stock market and how does it work? Let us learn today how the stock market was born. In the 17th century, the Dutch East India Company sent out hundreds of ships to trade silks, gold, porcelain, spices, and other goods around the world. But running such a big business wasn't easy. To pay for their expensive trips, the company turned to private citizens, who could put money toward the trip in exchange for a share of the ship's profits. By using this strategy, the business was able to pay for more and bigger expeditions, which helped both the business and its loyal investors make more money. By selling these shares in coffee shops and shipping ports all over the continent, the Dutch East India Company accidentally made the first stock market. Since then, companies have been able to support a wide range of industries by getting money from eager investors. There are even TV channels that are just for explaining how the stock market works. But the modern stock market is much more complicated than it was in the past. So, how do investors and businesses use the market now? Think about a brand new coffee shop that wants to join the market. First, the business will try to attract big investors. They get to invest first, and if they think the business is a good idea, they can sponsor its first public offering, or IPO. This puts the business on the formal public market, where any company or person who thinks the venture could be profitable can buy a stake. By buying stock, investors get a small piece of the business. Their money helps the business grow, and as it does better, other investors may see the opportunity and start buying stock. As more people want those stocks, their prices go up, which makes them more expensive for people who want to buy them and increases the value of the shares that people already own. By showing how many people want to invest in their idea, the company not only gets more money for its new projects, but the market value of the company as a whole also goes up. If, for any reason, a business starts to look less profitable, the opposite can also happen. If investors think the value of their stock is going down, they will sell their shares to make money before the company loses any more value. When shares are sold and demand for the stock drops, the market value of the company also goes down. If the company doesn't start making money again soon, investors could lose a lot of money. The supply and demand pendulum is affected by a lot of different things. Businesses can't avoid being affected by things like changing production technologies, changing labor costs, and changing material prices. Investors might be worried about changes in management, bad press, or bigger issues like new laws and trade policies. In fact, a lot of investors are also ready to sell valuable stocks in order to reach their own goals. All of these things cause daily market noise that can make businesses look more or less successful. And on the stock market, losing investors because a stock seems to be losing value often causes it to actually lose value. People's faith in the market can cause anything, from financial crises to economic booms. And because it's hard to keep track of this factor, most experts recommend investing for the long term instead of trying to make money quickly. Experts are always coming up with new ways to improve their chances of success in this system, which is very hard to predict. But only rich and powerful people could buy and sell stocks on the stock market earlier. Since the internet came along, small investors can buy stocks in a lot of the same ways that big investors do. And as more people learn about this complicated system, they will be able to trade stocks, help companies they care about, and reach their financial goals. The first step is to invest. Have you got started to invest in the stock market yet? Thanks for watching from the team of Finance Guru. Please share and subscribe the channel for many more interesting videos.